Investing insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day everyone, how are you going? It's Phil Tarrant here. I'm co-host of Investing Insights with the Right Property Group. I'm joined over video, the magic that is the internet, the magic that is voice and video conferencing now. My co-hosts from the Right Property Group, directors Steve Waters and Victor Kumar. Gentlemen, how are you going? You well?
Yeah, well, we are well, all things considered. It's a crazy world at the moment, as everybody would know, but we move forward. We go forward.
Yeah, we do move forward, and I appreciate you guys taking time out of your schedule to join me today for us to have a conversation and record our monthly podcast, which is very popular. It's I've really enjoyed being part of this with you guys over the last couple of years and watching the growth of this brand and the connectivity it has with property investors right across Australia. A lot of them are your clients, but there's also a lot of them property investors looking to be better informed. So I hope they're enjoying these conversations that we have. Where we are this month versus where we are last month is a very different circumstances. So when I look back at the last 2 years of us delivering this product, I think a lot of people get a lot of value out of going back and listening to some of the conversations we've had, because the rhetoric, the information, your advice, your interpretation of the markets and how you can best prepare yourself for market conditions and focusing on the fundamentals are now as relevant as what they ever have been before. So for those of you who have just found us, you've got 2 years of listening to go and listen to right now. Everything we've spoken about is as relevant today as what it was when we spoke about it. Obviously, markets move and specifics around different locations do change, but the basic fundamentals of investing in property in this current market is as relevant as ever. So use some of the time that you have in self-isolation to go and connect and enjoy that. Any questions at all, Victor? How do people get in touch with you again? What's the best way to connect? Have you got any discussions around any of the things that we've spoken about in the past?
So just go to questions@rightpropertygroup.com.au or just ping us on Facebook, send us a direct message, and we'll respond.
So for you guys, as business as usual for you at the moment, you're still doing what you're doing. You're still doing client meetings. You're still doing absolutely everything as per usual. You're just probably changing the way you're doing it a little bit.
Yeah, for sure. Like there are some people that across the world, not just our clients, that are potentially having their circumstances change. And we're very aware of that. And our suggestions to anyone who is listening whose circumstances may be up in the air is to just put things on ice. I think it is a matter of safety first and to keep the liquidity, to have the buffers in place and whatever that looks like for you in terms of cash flow. However, the other side of the fence too, whose potential jobs are secure, they're in a position to be able to move forward and attack, for want of a better word. And it is business as usual. And for us, clearly we've got our own challenges in terms of getting in, or clients being in front of us. So Zoom is getting a workout. Wouldn't you like to have shares in Zoom? And a lot of phone calls as well. But life goes on, we move on, and we just want everybody to stay safe and keep their health as a priority.
Absolutely, I agree with you. And as part of that, big acknowledgement to the healthcare workers out there right now who are going above and beyond and putting in huge shifts to help us through this health crisis. But, we'll have a chat about this today over the next 40 minutes or so, guys, around, where we are with this crisis right now and the fact that it is a global health crisis, but it is turning into a financial or economic crisis. So we need to be all aware of that. We need to understand how property has its movements and its place within that and where you can actually find some opportunities potentially in this market. And we've spoken about it for years as well across Investing Insights of the Right Property Group. How do I identify those opportunities and how to determine the base value of what constitutes a good asset and a less than good asset? We'll have a bit of a discussion about today, but I think the primary focus, Steve and Victor, should be around why the basics are so important in times of COVID-19 or any disruption to the market. And you have a particular strategy, both of you have a particular philosophy towards investing in property, both of you have a passion for property, and you both have a mindset around property as well. And that mindset being irrespective of market conditions is how you choose to approach the market, which means that you can be most effective. So we'll have a little bit of chat about mindset as well and how you guys see the world and how hopefully our listeners can take something from that and help shape the way in which they are going to interpret it. Now, Victor, this is moving is a very fluid market right now. What is going to happen with real estate into the future in the way in which properties will be transacted? It's moving by the day. So where we are today might be very different to where we are tomorrow. So we'll keep providing those updates. And I know you guys are more than happy to chat to anyone if they have any concerns about that. Questions at rightpropertygroup.com.au. But what we can expect for the foreseeable future, Victor, is changes and movement. Is that correct?
Look, when there is any events like this, and Steve, we've seen this before during the GFC, and any upheaval that plays with the investor's psyche, their psychology, you will see a flow of wealth happening. So for the people that are not prepared, in other words, they don't have their buffers in place, that they're overexposed, and they haven't reacted quick enough, they may lose the wealth to people that are prepared and that are able to see past the immediate emergencies and immediate circumstances, look at what the long term holds and making decisions that way. So if you look throughout history, even during the Great Depression in Australia, property transactions were still happening. Properties were still being bought and sold. Who were selling were the ones that were not prepared or were not able to hold on. And who were buying were the ones that had the money. And if you go back throughout all of our publications, all of our podcasts, all of our audios, we've always said, keep a cash buffer, be prepared, be liquid, always keep your equity liquid. And at this point in time, this is where you can take a strong look at where your portfolio is heading. And true to form, in most cases, and in fact, we were talking to one of our friends, and the comment was that this is the point in time where you will get millionaires becoming multimillionaires and the not so prepared losing immense wealth.
And that's across any asset, whether it be shares, bananas, boxes, or property. And as Vic rightly mentioned, this is everything we've been doing up till this point, till this 1 in 100 year event, if you will, could be training. You could look at everything that we've done is we've been training to be prepared for this point in time. And that training may have been cash flow management. So when we talk about having buffers in place and looking after the cash flow and the property, it's really more so about cash flow management. So making sure that not only is there a capital buffer in place, but there's also enough household budget cash flow in place as a mitigation, because those that haven't done that, those that haven't prepared may be under some duress over the next couple of months, whether that be 1 month, 2 months, 6 months, 12 months. And as a side point, nobody knows how long this will go for. And anyone who's trying to predict it is just looking to sensationalize something or get themselves in front of a camera, potentially. And anything that we're saying, we're not coming across as, well, that sounds really good, guys, but you're the property guys. That's your chosen asset. And we don't for 1 minute want to sort of perpetuate something that's not. All the fundamentals, no matter what the asset class are the same in terms of cash flow management and then being in a position to be able to execute potential opportunities.
Yeah, I think one of the things that we need to remember is that there are some of you out there, you should not even be looking at buying property or any assets for the time being. For the immediate future, may it be a month, 2 months, 2 years. For others, if you can, this may be the time people get more negotiable on selling their assets down to recapitalize or to save their homes or to put money back into their accounts. This would be the time to buy. So if your job's really stable and you've got plenty of buffers and plenty of equity behind you, just look at what's really happening. You've got immense number of incentives being thrown down by the government. We've got the lowest interest rates ever, and the chances are it might even go lower. And you can bet your bottom dollar that they will loosen the lending to restart the economy. Now, it's not going to be an instant start. It's going to take a while. It's going to take a little bit of traction. So in the immediate future, we may not see an immense drop in value. And in fact, I don't see an immense drop in value. At the worst case, it may drop by, say, 10, 15, 20%. But realistically, losses will only be crystallized by those people that afford to hold on. And if you track across history, even during the GFC and going all the way back to the Great Depression, the values did drop, but then they came back significantly. And our most recent event being the elections as an example, right?
Yeah.
So if you look at 2017, prices are, and I'm just, let's make these numbers up, right? Prices were at 500. Just before elections, it dropped to 400. After the elections, it roared back towards 500. In fact, just before the GFC, we were back at 2017 levels. So what we're going to see is a V-shaped recovery in property and in general economical ability to make decisions. The X factor here really is how quickly the companies will start, given the government incentives, and employment starts back again. And then, of course, the psychology, like we know, most people have taken a huge hit, not only just financially, but psychologically as well, because we all take things for granted. We think our jobs are safe, it'll never happen, our mortgages are safe, I'll always be able to afford it. And that'll take a while to get out of the psyche, just like the bushfires, just like the floods. When those areas got hit with bushfires, people say, I will never buy in there.
Yeah.
Look at Brisbane. Yeah. Right? I will never buy in Brisbane because it floods.
Floods, yeah.
3 years later, they all start buying, right? So this will...
Back in the flood areas too.
That's right.
It's an amazing event, realistically, because as much as this is a medical pandemic, it is also, I believe, a psychological pandemic as well, because people's minds are being literally screwed with, and a lot of the time it's for valid reason, but I think the media also has a lot to answer for in this in terms of clickbaitable material and the way that the internet has been able to perpetuate a message very, very quickly, whether that be good or bad. But if we sort of look back to the future, if you will, and this is as close to back to the GFC days in terms of consumer sentiment, commodity prices dropping or asset classes potentially dropping in value, but there's also a couple of major fundamental differences here. So one of them is that back in the GFC days, it was 7.5%, 8% as a cost of money. Today we're at 2.5%, 3.5%. Big difference. We do have an unemployment issue lying or potentially going to happen. But what we also have is a point in time where if we look at the pipeline, and we often, Phil, talk about pipeline analysis, if we look at the pipeline now, and we'll just talk about Sydney as one area, and we talked about this on a couple of podcasts ago, is that the pipeline is dry. So there's no construction that is in the pipeline, no massive amounts of construction that is going to be the accommodation for the continuing population growth. You overlay the psychological and financial barriers that are happening within the economy today, which is going to accentuate that building or lack of building issue, yet the population still grows. We will have that inflection point, which we keep talking about. It may even be brought forward. So if we have a cost of money that's 2.5%, 3%, an increasing yield in the fundamentally correct areas, then it doesn't become a debate or a question or a chat around my asset has just dropped in value and I can't afford to hold it, because we are looking at this over a 10, 15, 20-year period. It becomes potentially my asset is paying for itself, and now I have time on my side because we know that there will be a recovery.
So don't panic.
So don't panic is the bottom line. That's the long message. Don't panic, and hopefully you've got your cash flow in place and your mitigation in place.
I think this is the time to answer diversification, right? In terms of, okay, do I buy the $1 million home or the $1 million investment, or do I buy $200,000, $500,000 investment? Already we're starting to hear from our friends, clients that had previously bought, not using our services, but bought properties 1.2 million mark. That's the top end of town, and that's where most of the jobs have been lost. Of course, it'll flow through to the other areas as well. And naturally, just like the GFC, the compression factor starts happening, right? So people that are living in those $800,000 a week rental properties, they would have to reassess and say, we need to move. Right?
Yeah.
And they're compressing down to, say, arbitrarily the $600 area.
Yeah.
The 600 they move to as well, and they're compressing to the 500 or 400. The 5 and 400 have nowhere else to go. So generally what happens, and this is what happened during the GFC, is you get the rental bounce in that area, right? Now, I'm not talking about value here at the moment, right? I'm talking about the rental, the cash flow, because right now, value is irrelevant. Value is totally irrelevant. You could have the most valuable property that's actually going up in value right now, but you haven't got the cash flow to hold on to it, you're done.
Because that might be not around the cost of money, but employment.
That's right.
And so, and further to Vic's point, the reason we deploy the strategy that we deploy is because of this exact scenario. Like this, because we invested through the GFC and well before it, we, as Vic said, we knew that our rents would go up. Now, once again, I want to come back to the pipeline. If we overlay the fact that nothing's being built and we have a compression that is going down in terms of to the affordable corridors, it is potentially the making of a scary situation for renters in some areas, because you remember the time when, and maybe Phil, you remember this, when there was almost like auctions on the front lawns or balconies of houses that were for rent in Sydney because tenants couldn't get a leg in. And potentially we're back at, well, not now, clearly, but maybe it's 18 months, maybe it's 2 years' time, we actually get back to that. But once again, the reason we deploy the strategy we deploy is because of this exact reason. We like multiple streams of income. We still want the same exposure in terms of value within a market. So to your point, instead of buying the $1.5 million property with a 2% yield or a 2.5% yield, I would rather 3 $500,000 properties with potentially going into it a 4% yield, but I have 3 incomes.
That's right.
Because I don't have a situation today where my tenant paying $1,500 a week says, I've lost my job because the market's crumbled. Sorry, Jack, I'm out. The chances of all 3 of my tenants in the affordable bracket doing that is negligible. I still have my income.
At least a stream of income.
Well, at least, worst case, what are the chances of all 3? But I also have my exposure to the market, the same tune. But conversely, though, and to be totally fair, and this is where we are conservative, in the good times, so when the sun is shining bright, that $1.5 million property might have an element of amplified growth as a percentage. But you know what? I'll give that to you, because it's in times like this where the rubber hits the road and where the sun isn't always shining that I get to live, I get to eat, and more importantly, it allows me to be able to execute opportunities that are going to present.
So we'll be in the receiving end of the flow of wealth.
Correct. And that's the important part.
So when you look at the market we're in right now, we're talking about planning for the future and being prepared. Now, for those people who are prepared and have good cash buffers in place, have some good equity available to them, and let's say still in a stable and secure job, there's going to be market opportunities moving forward. For those people who maybe are less down the prepared path and it's a little bit shaky and wobbly, how quickly can you get prepared? Can you start making changes now to best position yourself for the future? And how far down the path should you be planning? Is it planning a month ahead, 3 months ahead, 6 months ahead, 1 year ahead? How do you get that balance right?
You always be planning, because you're always mitigating the risk, because risks unfold and opportunities unfold on a daily basis. So it comes back to basics in the sense that you always need to be looking at the cash buffers. I know that Steve's now hiring his bobcat to dig up all of his gold now that they stopped producing gold. So you've got to look after the capital point of view as well. So you can't be running your portfolio on the smell of an oily rag, right? This is where it'll come and bite. So you need to always have capital around. You also need to have the cash flow around. And importantly, you can't capitalize on any opportunities if you don't have a job, right? So the main thing in here is that there will become far less buyers in the market in the immediate future than there are opportunities to buy. So therefore, all vendors that do need to sell will become far more negotiable. And that's something that, we need to be prepared for. But again, I'm not saying that, we should be ambulance chasers. In a sense, there are people that you'd be genuinely helping them buying their property.
So if we explore that a little further, if we go back 3 weeks ago and how the world changes in the space of a couple of weeks, if we look at the Sydney market once again, or the Melbourne market, where the tempo of the market was amplifying daily and into a very, very buoyant market, those very same markets now, I would suggest, will come back to a normalised market in terms of the amount of buyers and sellers necessary, so that
the balance will return.
The tempo of the market will reach a point of first equilibrium. So as it drops from a seller's market now into a point of equilibrium, enough buyers for enough sellers, and then potentially from a psychological point of view, the sellers will be thinking to themselves, well, I'm scared there's not going to be enough buyers. So now from a buyer's point of view, it becomes not a price-driven scenario or negotiation. It becomes a terms and price-given scenario. So no more 66 Ws for all you New South Welshmen that know what that means, an unconditional contract or a cash offer. You will be coming into a time where you have all the cards rather than the buyer has all the cards. But first of all, you need your employment, because that means cash flow and that means security.
when you guys, are keeping abreast of what's happening right now and the rapid period of spate of changes, this is really a 3-week scenario that we're in right now, maybe nearing a month for people who are on a little bit tighter. It just goes to show, last time we got together, we were talking about it being a seller's market. There was not many properties for sale and a whole bunch of buyers out there trying to secure it. It's changed pretty much overnight, hasn't it?
It has. It has. And this is the point. And we don't want to be the people that say we told you so. However, but we did, is that markets are fickle. Things change quickly, but the data will lag. And if I give you the both scenarios, so let's talk about the shares and the stock exchange versus property. Not that I'm trying to create a battle of which is better, because they both have their place. And we did a video and talked about this the other day, but the tempo of the share market is measured by the second, by the minute, by the hour, by the day, by the week. And you can see those fluctuations immediately. So that will give you an indication of what people's psychology is or psyche is into that market immediately. The share market's plunged by some 40%. However, if we look at property and someone has the same psychological scenario where they're panicking and there's mild forms of anxiety, the measurement in terms of their psyche is 4 months long. Because what happens is, first you need to have the argument with yourself, should I sell the property? Once you've made the decision, you need to find the agent, then you need contracts drawn up, then the property needs to be marketed, then a buyer has to be found, and then there's the settlement period. So that could be a 2 to 4 to 6 month period. And
or
then,
if you've got the terms, it could be 12 months.
Or if you've got the terms, it could be 12 months. And then there's another couple of months on top of that for the data to show up. Mm-hmm. So we won't know, if you're an unsophisticated investor or you're just an observer that's looking for purely data, you won't see today's psychological valuation of the market until 3, 4, 5, 6 months down the track, by which stage everything may be back to normality, or it may not.
Yeah, who knows? I think what's going to happen with this is that there will be this health crisis, and we're all across all the actions that are underway to try and, everyone talks about it, flatten the curve. So, to push it out so we don't have huge spikes in the contagion. But it may take 1 year, 18 months, 2 years before we get back to a different economic cycle, as a lot of businesses will hurt through this period of time. A lot of people will come under stress and under pressure. But I've been thinking about, I'm actually looking forward to doing this exercise to just essentially reprice our portfolio. From a cash flow perspective, you guys have spoken a lot about cash flow right now, and one of the biggest challenges, and this is a portfolio that you guys have been critical in helping us build over what would be now, Steve, 7 or 8 years, I would imagine, based on the strategy that we've employed, and we'll get into that in a moment. But one of the biggest challenges with that portfolio, it's not a small portfolio, it's not massive, but it's larger than most people's portfolio. The biggest challenge with that is that each property costs us about $2,500 a year to hold. This is going to completely change our cash flow situation on our portfolio if we have interest rates coming back by 1.5%, maybe 2%. It should be neutrally geared. I look forward to seeing it.
On the assumption that the tenant is able to pay and you're still tenanted, but of course the government is starting to throw in incentives in terms of both the tenants and landlords, and that's something that we need to be mindful of as well.
Yeah, absolutely. But to your point, Victor, that you made around affordability, and this lends itself to the strategy that you employ, and that has not changed since we've known each other. And we must know each other now for nearly a decade or so. Mm-hmm. It's the base strategy of identifying good quality assets in affordable locations that have good cash flow potential or have the ability to upside or manufacture equity on. You haven't really deviated from that strategy at all, have you?
No, I haven't. And I must also stress that a lot of people base their investing decisions based on software and based on projections for the next 10, 15, 20, 40 years. This is something you can't predict, right? So if your whole investing was based on a projection of 40 years and you are in year 39 and you have this, you're in all sorts of grief because you've only focused on one side of the equation, which was the value, rather than the cash flow. We need to be focusing on both sides of the equation every single time and make sure that we are able to hold onto the portfolio in the bad times. That's the most critical thing in investing. then the rest will look after itself, as long as you can hold on to the property.
And even if you look at your portfolio, Bill, everything has a direct reason for being in there. For Vic's point, it's cash flow first or cash flow management first, because time will give you the growth. And if you're in year 39 of that 40-year plan
it comes crashing down,
and you've had a synchronized double hit because you're about to retire, you've got your superannuation in the share market, and you're wanting that now because you're retiring, and you just also took a massive cash flow hit at the top end of the market in residential real estate or commercial, then you might be having some mild anxiety attacks. But also on the other end of the journey, if you're in year 2 of your 40-year plan and you've chased the blue chip property and you've lost your job and your tenant, it's bloody lucky that you've got rates at 3.5%.
Yeah. This is one of the things we do, Steve, when we sit down with the clients, is we do the reviews. We are looking at this worst case scenario to say, okay, now that you've got these many properties in your portfolio, what does it look like from a worst case scenario? And then we balance it out to say, okay, right now you're carrying, as an example, say $10,000 negative cash flow. Let's get in a property or a strategy in play where it'll negate the negative cash flow so that you're running a relatively neutral portfolio. And that way it allows you to weather the storms like this storm quite well. No one will come out of this unscathed. I don't think so. There will be some that'll lose a lot, which is unfortunate. But if you keep your wits about you, what you'll find is that there will be a definite bounce in the market as long as you can keep your wits around you.
Yeah, it comes down to mindset and how you choose to approach the world. And, to pick up a point you made, Steve, around where you choose to get your information from, the media. And I've been watching this, and I try not to do it because as soon as I go to any of the media or more tabloid media or social media, I instantly feel depressed, right? Like it just completely shapes what you think in a way in which probably isn't that positive. So, and then you turn to other sources, more reputable sources, which is a lot more balanced. And then you sort of sit there and think, oh, well, it's not great, but it's not as bad as what you would think it would believe. So you need to be careful where you get your information from in terms of giving yourself an attitude to proceed and hopefully excel in this particular market. But the same applies because it's for property investors, where you get your property investment information from right now. Because if you read some of this media, you're using that to formulate your decision making, you might not be making the right decisions. What would you be resting on right now in terms of the right information to help you make more informed decisions?
Look, before I answer that, I want to go back because like a good journalist you are, you just drew me into something for me to have an opinion, which I probably shouldn't have. But there is a media organisation out there and a reporting organisation out there that should be bloody ashamed of themselves in the sensationalistic way that they've reported it. And it's around the story, not potentially, there will be 20% unemployment or 10% unemployment. There will be a 20 to 30% real estate market crash. You know what? Like it's irresponsible journalism, and it's also the potential to start a self-perpetuating market. Because let's not forget that when you have a positive media, it can perpetuate in a positive manner, hence the FOMO boom. But equally important, too much negative media will create its own whirlpool effect as well. And especially when it's not backed up by fact, it's backed up by 18-year-old assumptive journalists that haven't had a day's breath on their own. Oh, geez, I was going to say something really bad then.
Tell us what you really think, Steve.
I may not get another listener for the rest of our lives.
Yeah.
But look, I'm pretty passionate about it because, look, we've been doing this now for some 20 years. So had mountains and mountains and mountains of different property cycles. And my suggestion to people, even if you don't want to listen to us, that's okay as well, but at least listen to someone else who has been through multiple markets, that this isn't their first hiccup, and that just as importantly has been able to steer people through these times by implementing a strategy to begin with that kept them safe in moments like this would be and even if, like, I'm not talking about us, there's other people that are equally as efficient and experienced as us.
Yeah, I agree with you. And I'm seeing this now, and I have a unique role within the property sector in that I know most people who operate within this marketplace, whether they're buyers agents or real estate agents or demographers or property analysts, and it's a real privilege for me to be able to be that connected. And I'd say it's probably a pretty unique role across Australia. And one thing I get comfort out of is the fact that we have this cadre of professional people across all the sectors which are important for property investors: accounting, property buying, finance, etc., that I know their intent is correct and they're there to actually offer and deliver exceptional services and exceptional advice and recommendations to property investors. That gives me a lot of confidence. On the flip side, there's a lot of people who aren't like that, and I'm not going to mention who they are. And this comes down to, if you're in the market right now and you're looking to make more informed property investment decisions, you've got to be conscious about who you're chatting to. Are they acting and operating on your behalf? You're going to see a lot of people come out of the woodwork over this next period of time with schemes or some other, unique way to invest in property. The purpose of this podcast, guys, and what our topic is why the basics are so important in times of crisis, in particular COVID-19. This is when you're going to know who's good and who's not. And, it is your responsibility as a property investor to make those decisions. You've got to be accountable.
Absolutely, you do. And at the end of the day, nobody holds a gun to your head to make a decision, but you just want to make sure that decision that you are about to undertake and spend, $500,000, $1 million, whatever it may be, has been well researched and well informed, so that you do sleep easy at night, which is one of our barometers. How well do you sleep at night? And that usually comes around cash flow management.
Right, and the decision, you need to make sure the decision is not fueled by fear or greed. Right, because both sides of the spectrum will hurt you in today's market.
Absolutely.
Yeah, proceed with confidence, proceed with caution, and make sure you're informed. And what we're talking about here is, one of the upsides of this market for people who are currently property investors is the fact that the cost to hold your property should be decreasing purely because of interest rates. Now, the challenge you have there is whether or not you can keep a tenant in there. And the government's working on this, and we'll keep updating this on smartpropertyinvestment.com.au. And I know you guys will be producing stuff on your website, rightpropertygroup.com.au. So go and check out both resources. But this compression factor, Victor, that you spoke about, I might just get you to just articulate that a little bit more for our listeners, in that if they currently have assets and are a property investor, how that works. But then for those who are looking at maybe entering the market right now or doubling down, and if they can proceed with confidence, acquire some more assets, we're talking about investing in affordable areas. Now, I think a lot of people get confused with the word affordability, meaning affordability means it's a shit property, to pardon my French.
Yeah.
Affordability is pretty much what is affordable for most people that live within a particular area. And every single suburb, every single area, every single state capital, every single location is different what the measure of affordability is.
That's correct. And it also ties back to your affordability factor as well, how stable your job is, how much slippage there is between money coming in and money going out. In other words, how much is left over. And naturally, you also still need to be looking at the employment nodes. Just because something's half price, but there's no population or jobs to support it, it's not going to help you in the long run.
So if you're looking to enter the market right now, how would you be approaching it?
Well, the first thing I would look at is obviously making sure that I have got stability around myself first, right? Stability in terms of job, stability in terms of if you're not able to find a tenant for the next 2 months, and it could be possible. Would I be able to hold on to the asset? And looking at the worst case scenario and then saying, okay, where does this fit so that I'm not losing momentum? And then, of course, comparing it against today's values, not yesterday's values, and projecting that it may go down initially before it bounces back up again in terms of value. I would be looking more so for the ability to hold onto the property, still select a really good asset, that's key, in good areas, good metropolitan areas at this stage. And I'll be looking at properties that would appeal to the masses because at some point in time, you may want to offload it in a better market to then realize your gains, to then perhaps pay down other debts that you may have accumulated, such as your owner-occupied debt. And that's the most basic, first-hand approach before you try and get fancy with spreadsheets or anything like that.
Yeah, and I want to reiterate the point too around the because what Vic's talking about is cash flow management, because cash flow management comes from not just your own liquidity, but also liquidity within the market, meaning how liquid is this asset should I need to sell it? What's the demand from an accommodation point of view, because that provides the cash flow, being the tenant, and then as that yield increases, so too does the value in a metropolitan area, because it's not just about then the want, it's from an owner's point of view or an owner-occupier's point of view, but also from an investor's point of view. So once again, if we relay that back to the Sydney GFC time, Phil, when, realistically, that's when you started. It was at the end of the GFC where we were getting 7% yields in Sydney. Now, we bought through the GFC. In fact, we probably bought more properties during the GFC than we did post GFC, because it was an opportunity. It was in metropolitan areas where accommodation is needed. There was a lack of supply once again in the pipeline. And as a result of that, we got our 7% gross yields across residential in Sydney. And I'm not saying Sydney's the only market, I'm just talking about that one because we've mentioned it a few times. But as the yields in Sydney hit the 7%, so too did the mass of investors come out of the woodwork, because it was getting to a point where they identified it was cheaper to own the property than it was to rent the property. And if you compare that to today, it is the case. It is.
More so.
You look at the biggest expense and the biggest income, rent and mortgage, it's potentially cheaper to own it today than it is to rent it today. And I think people are not fools. The general public aren't fools, and they will certainly explore that that option as it unfolds. But if I compare today to the GFC, once again, the trigger points are different.
Very different.
The fundamentals of this psychological scenario we have across the economy worldwide is different than the trigger or the reasons for the GFC. However, the outcome will be the same. Without doubt, the outcome will be the same as recovery happens. I think as quick as people got out of the market, whatever the market looked like to them, they're going to get back into it threefold.
I think every time we sit down with people that have been investing for quite a while, the common thing they say is, I wish I'd bought more property during that period. I'm not trying to drum up business over here, just trying to get you to understand that adversity brings opportunity. And usually what you find is that there is a strong resurgence of value, or the value that's been lost. So now would be a good time to buy. But you shouldn't also overcommit and buy too many too rapidly, because we don't know how long this crisis is going to last. We don't know how long the values will remain depressed, because the element over here that's different to any other single time apart from the Great Depression is the employment factor, right?
Correct.
So until employment really picks up, you're not going to see a huge bounce in prices, but the minute it picks up, you'll start seeing prices taking a run.
And it will. This will turn around. So it's really about curing. And once again, this is not drumming up business point commentary. It never has been. You are securing tomorrow's opportunity
Today.
Potentially today.
Yeah, and I hope you brought that point up, because, in 10 years' time, hopefully we're still recording this podcast, guys. Hopefully we're saying, oh, geez, I wish I bought more when I could have during that period of time. That would have been a great time to buy. Or, geez, we're happy didn't buy too much at that point in time. But remember 2 years after it happened, how good those buying opportunities are. So you need to be engaged and connected. And a point that you made, Victor, is that it's the decisions that you make today is going to show you what your portfolio is going to look like in 5 and 10 years' time. And having some understanding about your own personal portfolios, very much it was during the GFC that you both built out exceptional base portfolios, which projected you into doing a whole bunch of other stuff and creating wealth through property in different ways after the GFC. But that was essentially the making of a lot of your own individual portfolios, sort of running up into and during. And then, I sort of come to the stage a little bit later and got the backside of the GFC. That's when I started investing. But I realised a lot of those benefits coming off it at that point in time. And in many ways, that's the reason why I have the portfolio I have today.
Yes, exactly, because you're able to expand, consolidate, and so on to where it sits today. And portfolios like ours, like yours, like our other clients, I think they'll come into their own now. This is where they'll shine.
That's right.
Yeah.
Bill, I wanted to talk about one of the bank's help in terms of helping people hold on to their properties, which is giving them 3 or 6 month moratorium on their mortgages. It is something, if you needed to do it, you need to do it. But there are few things that you need to keep into account, right? The information stands right now. The interest gets capitalized. So therefore, when the 6 month is over, your loan amount is higher. Plus, then you're tagging on another 6 months time frame into your loan. So overall, you end up paying more. But if it means that you are able to hold on to your portfolio, do it, right? There are few things that you probably would need to do beforehand, such as, and I haven't fact-checked this, but this is logical, right? The few things that you would want to do is, if you've got a redraw, pull that out first before you ask for that moratorium, because chances are the bank will say, you know what, yeah, we'll give you 6 months reprieve, but your redraw's gone, right? So it's really important that you think this through before you jump on and say, hey, you know what, I'm going to build myself 6 months worth of cash flow by not paying any mortgages. In the long term, you're actually paying. The bank always wins.
Yeah, this is the time to be even more methodical than ever. So don't be reactive, because some of these decisions may hurt you in the long run. What the banks have done is admirable. There's no doubt about that.
Yeah, I'd agree.
But the banks don't do anything without making money, and this will be a positive thing for their bottom line in the years to come, because it just keeps interest on interest on interest. However, cash flow is king. So if it means you need to take a 3 or 6 month break, then we certainly suggest you do it. One of the questions we've had quite a lot is, well, how will that affect me with future potential borrowings? The answer is, we don't know.
First time it's happened.
Yeah, and nobody knows. But what I would say is that there's going to be a hell of a lot of people in the same position, as in Mr. and Mrs. Public. So that will roll out. But one of the things that you should be doing now, because it's never been a better time in history, is to actually negotiate with the bank in terms of your rates. Like you will never get this opportunity again. We've never seen it. It's never happened. So ring the banks up, and if your interest rates are over market, whatever market looks like at this point in time, then what's worked very successfully for our clients is you ask for the reduction in the rate and you give what other banks are willing to give you.
Including the cash incentives the other banks are giving.
Including the cash incentives, yep. And you usually get, your first answer will be no, then say, well, I want to speak to the team leader, the manager, and then you'll get a little bit more traction, and then it'll be no. Then ask for the retention team and start that again. And probably 70% of the time you'll start to get a reduction, as long as everything is in order, because every basis point is money in your pocket, literally. And once again, this is the time, like never before, that you get a chance to negotiate. Everything is negotiable at this point in time. Everything.
Yeah, it's a good point. Victor, I'm happy you brought up that point in relation to, the decisions you make now and how it may impact you in the future. So, my view of it all is that you need the right information, you need the right guidance during this period of time, and that might be your buyer's agent. I'm leaning on you guys personally as a property investor and as one of your clients to help me shape how I approach our portfolio. And Steve, what we might do actually is a piece on the Smart Property Investment Show where we can do a bit of a portfolio review just to give a bit of an update on where we are right now. And we haven't really bought much in that portfolio recently. We've just been tinkering with it and waiting for opportunities. So, you know what, maybe this is one of them, but have a bit of a discussion about how our cash position has changed on that. So we'll do that definitely. But, buyers agents, mortgage brokers, your accountant, your financial planners, you guys are happy to chat to people if they just want to, ask what they should be doing or how they should be approaching this market, Victor?
Absolutely. And then sometimes you do need a reassuring voice or a voice of reason, especially with someone that's already gone through this in the last GFC and has seen people lose money because they are scared or acting out of fear. So you're welcome to give us a yell, questions@rightpropertygroup.com.au, or just reach out to us on our socials.
Yep, happy to chat, because sometimes our job is to slow people down as it is to help them adhere to the timeline.
Yep.
Yeah, that's good. And, you don't want to be missing out on opportunities because you're stalling decisions, but you don't want to be making decisions impulsively. And And just a reminder for our listeners, look, I hope you've enjoyed this chat we've had today. This is just a general conversation. We're not giving any advice whatsoever. This is just really the way we see the world. So, hopefully it's going to help shape the way in which you approach this market moving into the future. But the guys are happy to have a chat with you if you want to actually get involved and speak specifically about your portfolio. I'll be doing that personally, and I highly encourage you to speak to whoever you use as your advice panel, your A team. Draw on them right now, and the good operators, the good professionals will be very accessible for you. Gents, hopefully next month, I wonder what we'll be talking about.
Well, I wonder if we'll be face-to-face next time or, over the interweb like we are at the moment.
We missed the coffee, Phil. He saved money buying us coffee.
Mate,
about cash flow management, Phil.
The cash flow management. You know what? To be fair, this has gone pretty well. So I know this is audio for our listeners, but we're keeping very visual. I can see Steve and Victor. They're working. They're still doing what they're doing. I can see them. We're still connected. We're still engaged. I do prefer doing it in person because, number one, I enjoy catching up with you guys. But number two, we have a good time when we get together and we deliver a good product across this podcast. But, this has been good. I'm happy with this. We can press ahead like this until we can get back together.
Yeah, and feel free to subscribe on YouTube for our property group. We have, hundreds of videos there, educational pieces or opinions or whatever it may look like. So make sure you subscribe to that as well. And as usual, we love the ratings on this podcast because it means a lot to us as well.
Yeah, nice one. And I appreciate them as well. It's good, and it's a real privilege for us to be able to deliver this information. And we know how many people listen to this podcast as well. So it's nice, and this is me personally. I'm a journalist. I'm not a property investment professional, but to know that what we do is actually helping people through what is sometimes good times and what is less good times. And we're in one of those less than good times right now, but I think we've articulated the opportunity for people to navigate through this particular market, why the basics are so important in times like COVID-19. And this is going to be a theme for us moving forward. I doubt we're going to probably record a podcast for the next 2 years without talking about COVID-19. This is the world before COVID-19, the world after COVID-19. So that's going to be the benchmark moving forward. And for our generation, or for the next 100 years, this is going to be a formative period of time for not only Australia but globally. So we'll try and keep you informed, connected and engaged as we deliver these podcasts. Gentlemen, thanks so much for your time. We'll be in touch. We'll chat again soon.
Love it. See you later.
Nice one. See you guys. Bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.